Hi, this is Peter Hans, and welcome to this week's episode of Between Two Chains. This week, I'm joined again by a longtime co-host, Jeff Dorman, Arca CIO and co-founder. We talk about the really strong start to the year in digital assets and why, frankly, we don't think we'll see the lows of 2022 again, or at least anytime soon. We also talk a lot about the regulatory environment, what it means, why we think it's happening, where do we go from here, and frankly, whether we agree with it or not. I think you'll really enjoy the episode. I know I enjoyed talking to Jeff as always. So thank you very much. Please rate, review, and subscribe. This commentary is not intended to be investment advice, investment research, or recommendation. Please consult your investment professional for your own circumstances. Hi, this is Peter Hans. It is February 21st, and welcome to this week's episode of Between Two Chains. I am joined by Jeff Dorman once again. It's been a little while, Jeff. How you been?
I'm doing great, sir. Good start to the year. How are you?
I am doing well, doing well. Youth softball started. We had our first game last week. Big 16-10 victory for the 8U Supersonic. And that's why we get up in the morning, right?
I agree. Work's enjoyable, but nothing like being on the diamond with the 9 and 10-year-olds or 8-year-olds.
Yeah, definitely. Season going well for you?
Yeah,
give the people
seasons.
what they want to hear.
Yeah, we'll start off a little baseball. Yeah, my son's on a travel team out here in LA, top level. They're doing pretty well. Going out to Arizona in the middle of March for a tournament. Little League's about to start. So the Delray American Little League out here in LA was runners up in the state for the 12U division last year. My son's 10U, so we'll see how it goes this year. Be on the Washington Nationals. My daughter's playing for the first time on the Mud Hens. So yeah, a lot going on the diamond out here in LA.
Mud Hens is a good one.
Yeah. It's actually nice. My son was on the Tigers last year, and now my daughter's in the Mud Hens, and the Mud Hens are actually the AAA team for the Tigers. So
it's very
full
fitting.
circle. Yeah.
Are they going to call her up?
I think so. I don't know. She's a 6-year-old, but she can mash the ball.
So this is in the digital assets world, it's an interesting start to the year. And I don't think we've talked about this on the podcast. Obviously, we have privately, but I don't think a lot of people would have, in December said we'd be up, 40+% or whatever it is, kind of year to date. What are your thoughts on the overall market here?
Yeah, I mean, there's definitely a lot to unpack. I think, I'd say the last week, especially, probably the most interesting, in the sense that, most people were looking at macro basically from October 2021 until the end of last year, right, as being the driving force. I think we come at it slightly differently. I think from October 2021 to call it May 2022, the macro picture was really driving everything, right? Just because the rate of change with rate hikes and further expectations was just beyond what anyone thought. I mean, we went into 2022 thinking we were going to get 3 25 basis point hikes, and instead we got 4 75 basis point hikes plus a 50 plus ongoing 25s, right? So, I mean, that rate of change was just, well beyond any standard deviations of what the market expected going into the year. So that was 100% a driver early in the year. But the second half of the year was not, right? The second half of the year was driven by the ramifications of Luna and UST and Three Arrows and Celsius, and then ultimately later on the Ethereum merge from a positive side, and then going further FTX and BlockFi and everything else that came, right? So we've been, in my opinion, outside of macro for really quite some time. But those who still believe that that's the driving force, you could have made that argument up until a few weeks ago that, okay, starting in October of last year, we started to have peak rate expectations. Rates started to come down. The dollar was starting to come down. You could at least sort of hang a little bit on a thread of, macro is the biggest driver. But last week was a huge deviation. Last week you had tech stocks higher, digital assets higher, most value stocks lower, the dollar higher, rates higher. So, I mean, if you were hanging on to macros driving everything, I mean, last week just threw that completely out the window. And I think digital assets specifically, there's a couple of real reasons why this rally is happening right now. I think the first is, and I actually listed maybe 5 of these last week on Twitter when I was talking about a couple of the reasons. I mean, the first is just that digital assets are proven to be really resilient. I mean, the second half of the year was abysmal from a news standpoint. But outside of Bitcoin, which was down 16% in the second half of the year, most other digital assets, especially some of the larger caps, were actually higher throughout the second half of the year. And that was during a time when FTX equity went to zero, BlockFi equity went to zero, Voyager equity went to zero, right? So it was really the equities of companies in this space that were failing. Meanwhile, the tokens themselves were actually doing pretty well. So I think that resilience is starting to attract investors again. I think also you're starting to see a real change in usage again. We all know this is a pretty reflexive industry because most of the companies and projects in this space are really infrastructure companies. So what that means is that when users start to go away and volumes on dexes start to go away, and you have a real crash in prices, which is what we saw last year. And by definition, the same thing can go the other way. So we have users starting to come back, we have volume starting to come back. And as a result, you have prices starting to accelerate. That won't always be the case. I think eventually you'll see more companies and projects in this space that aren't necessarily tied to just usage and volumes, but right now a majority of them are. So you get that reflexivity on the way up and the way down. And I think lastly, probably the most important part here is that the biggest fear factor that everyone has right now is the U.S. regulatory assault, which I know you have a lot of opinions on, and we'll probably hang on to this topic for a while. But if you actually think about what that means for prices, it's not that big of a deal, right? And what I mean by that is the assault so far from Washington has been on stablecoin providers. It's been on staking providers. It has been on, now even on RIAs with regard to the custody rule. But what it really isn't on is any of the tokens or protocols themselves. So we were at a market where almost 20% of the market was in stablecoins. And you're starting to see a lot of people say, oh, well, if stablecoins maybe aren't that safe, or at least are a little bit, scary from a regulatory standpoint, maybe I'm better off not being in stablecoins and actually being in Bitcoin or ETH or some other large caps. And you're starting to see some of that rotation out of what, was deemed safe even a few months ago and into more riskier assets. And more importantly, you're seeing a lot of this activity happening just outside the United States. And I think, as much as we sometimes forget it, especially here in the US, this is a global industry with perfect substitutes. When one staking provider gets shut down, or one stablecoin gets shut down, or one exchange gets shut down, the market just gravitates elsewhere. And we've just seen that over and over and over again in this industry. And you're seeing Asia wake up, a lot of the volumes, a lot of the price actions happening, overnight here in US hours and happening in Asia. So you put all three of those together, right? You get, the fact that tokens are resilient, the fact that this is a global industry with real demand coming from other places, and the fact that, some of these safe havens maybe not as safe, and you get a little bit of a pop into risk assets.
Mm-hmm. So I do think there's a few things to talk about as it dovetails into the regulatory environment. But before we get there, you mentioned volumes increasing, and I do want to dive into that a little bit, because I think one of the characteristics that we saw in the back half of last year was the market was essentially a zero-sum game. The narrative of larger institutions and real capital pouring into the market kind of at least paused, let's just say. And the only movements in tokens you saw were essentially rotations, right? There was really no one leaving the market after a certain point, but there was certainly no one new entering the market. So is what you're seeing now, or what you've seen, I guess, year to date, increases in actual volume? Is it more active wallets, more active people trading, people who are on the sidelines coming back into the market? Is there any data that you've noticed that's particularly telling?
Yeah, I mean, all of the above, right? So usually the easiest things to track are wallets and actual trading volume, right? There's other things that you can track as well. But if you look at January, just for example, the month over month increases on average across both decentralized exchanges and centralized exchanges, on average, is about 65% growth. Binance and Uniswap continue to gain market share. The rich keep getting richer, given that there's very, very difficult to kind of start something new right now in the current regulatory regime. But that's a real growth in volume. From a wallet standpoint, I think you saw a huge spike, especially in non-custodial wallets. I don't have the numbers in front of me here, but especially like Trezor and Ledger, some of the non-custodial options in the wake of FTX and BlockFi and other places, saw a huge spike in sales and in new wallets as a result of people wanting to get their assets off of centralized exchanges. So you definitely did see some things that were quantifiable there as well. And then little things, right? I mean, even though the ETF and ETP industry is not a huge driver of overall activity in blockchain, just because it's limited product sets, it is still a good barometer of kind of retail flows. And we did start to see inflows pretty much every week this year so far. We've seen inflows into both Bitcoin and Ethereum, ETPs and ETFs. So you're starting to see a little bit of new money come in. You're starting to see that reflected in volumes and wallets and other things that are trackable. There's still definitely rotation going on, right? I mean, even just in the first 6-7 weeks this year, you've seen, first it was, liquid staking providers like Lido that were kind of leading the charge. Then it was a little bit of a bounce back of the Solana ecosystem post FTX. Then you had anything related to layer twos. So you've had a couple of, thematic moves that kind of come and go. Right now, the big one obviously is Bitcoin around ordinals and potentially even some layer two activity like stacks built on top of Bitcoin. There's always going to be a little bit of hot potato, a little bit of that rotational game going on. But there's real money coming in. There's real increase in volumes, and like I said, some of it is just kind of reversion to the mean from a post FTX world. But some of it is new, and you're seeing it on your side as well, right? There's new interest. There's sometimes it's just as simple as a flip of the calendar is all it takes for a little bit of renewed interest, but it's real, both in terms of quantifiable as well as anecdotal evidence.
So I guess summarizing all of that, do you think there are continued legs to this rally?
I would say it was, in my opinion, it's easier to tell you when the bottom is in than it is to tell you how far higher you're going to go, right? I think there are more signs to show that it's unlikely that we're really going to fully retrace anywhere close to the lows that we saw towards the end of last year. There's just no real evidence, in my opinion, to suggest that what we all the different idiosyncratic micro events that we saw last year, from the levered blowups to the fraud to some of the even end of year window dressing that we saw. I mean, that was probably as big of an indicator as anything, right? Things that were digital asset related, that were largely owned by people who were not necessarily full-time in digital assets. Things like Solana, things like Coinbase stock, things like Grayscale trusts. Those were really sold hard into the end of last year. And I think a lot of that was window dressing. People were just like, I don't want to show this on my books at year end. I just want to be out. In some ways, crypto was toxic for people who weren't necessarily full-time in the space. I think all of those factors, you're just not going to touch those lows again when there's this much cash sitting in the ecosystem. There's this much growth potential. There's this much being built on top of this. In terms of can the rally last and how much higher can you go, I think that's really hard, right? Because 2021 was such an outlier in terms of growth and usage and volumes and new products, right? I mean, you saw the explosion of stable coins, you saw the explosion of DeFi, the explosion of NFTs. So that's probably not the baseline. At the same time, the 2022 lows was also not the baseline, right? That was just, a massive trough around everybody fleeing centralized exchanges, having assets trapped on places where they thought their assets were theirs, but now instead they're just, in line as a creditor in a bankruptcy trial. So those baseline is probably not real either. So, one of the things that our analysts do all the time is they're trying to run bull, bear, and base cases, and the variance is really wide, right? It's really, if you're running a typical equity model or even a fixed income model, you generally have a pretty good idea of what revenue growth will look like or what EPS growth will look like. Maybe you're off by a few percentage points here and there, but you can still have a reasonable expectation as to what this business will look like. Right now in digital assets, it's really hard, right? Because the highs were so high and the lows were so low that anywhere in the middle, you're really guessing, right? Your inputs have a lot of volatility to them. So, I think there are reasons to believe that certain pockets of growth are real here and will continue. Whether or not they ever get to that 2021 level again, I have no idea. As well as but I do feel pretty strongly that we're not going to get anywhere close to that 2022 trough level.
Of call it, post Three Arrows, July, right? Because even in the fourth quarter, post FTX, we still never got. At least if I'm thinking about, say ETH, right? We never got into sub 1,800 or
Right.
so levels. I think it would be, it would take a lot to get back there, because I'm not sure, ultimately who the marginal seller is, unless it's just a complete capitulation.
Right.
You brought up about infrastructure, and kind of a lot of what we're seeing right now is infrastructure, and I think ETH is a good example of that. As you look fundamentally at the ecosystem right now, and where we stand, do you see any name at all, any player, any protocol as having true moats, and true kind of staying power? I mean, ETH is probably the closest thing that comes to mind.
Yeah.
But I think part of the reason why we're seeing all of this, when you talk about analysts and forecasting, right? It's because you're not going to model, I don't know, your retail, building a model on a retail name. You're not going to all of a sudden model floor the activity to zero, but the switching costs here are so low, and the velocity of funds is so high. And I think Axie Infinity, we brought that up before, is a great example of something that can have like billions of dollars of run rate revenue, and then within like almost overnight, that's hyperbole, but like it can go to basically a couple
Yeah.
$1,000,000, right? And it's just because the switching costs are nothing. So outside of maybe ETH, like, is there anything that is really defensible?
Yeah, well, it's. I'm probably going to talk out of both sides of my mouth here for a minute, though, because on the one hand, I really do believe that in a global industry with perfect substitutes, it's very hard to do what you're saying, right? It's very hard to have a moat because there's always going to be new entrants. There's always going to be competition. It's just impossible, really, to have a monopoly. At the same time, when you look at what regulators around the world are doing, especially here in the US, you kind of create monopolies by accident by making it so difficult for new entrants and making it so difficult to compete that in some ways, I mean, that's why Binance is up to almost 80% market share in spot trading, right? Uniswap is up to 75% in decentralized spot trading. DYDX is 72% globally. Ethereum is roughly 66% of TVL, right? You go down the list and you look at, well, the bigger are just getting bigger. You almost are creating monopolistic tendencies, just in the sense that it's really hard to enter the market in an uncertain regulatory regime. On the flip side, we just saw the opposite of that, which is, OpenSea was by far the most dominant NFT platform for most of the last year and a half. Well, Blur is now 3 times the volume as OpenSea, and Blur started basically a couple months ago, right? I mean, just in the last 24 hours, for example, OpenSea has done 16 million of volume. Blur has done 56 million. There was 33,000 traders on OpenSea. There's now 13,000 on Blur, and sales counts was 45,000 on OpenSea, 35,000 on Blur, right? And Blur came out of nowhere, just like other competitors like LooksRare and X2Y2 came out of nowhere a few months ago as well. So it's hard to know if these are flash in the pan. It's hard to know if they're just incentive based or if they're really going to have staying power. But what is obvious is that when you have a token and you introduce the idea of an airdrop, or you do anything that basically incentivizes your users to also have some sort of quasi equity or upside in your project, you can compete with the big guys, at least for a short period of time. Now, whether or not that's sustainable or not always comes down to the same thing, right? Is it a platform people actually want to use? Are there other things that make me stay there? But you can see it, right? As big as OpenSea was, this is a real threat right now. And Blur is definitely taking market share from that. So could you see someone do the same thing to a Binance or to a Uniswap or to a Chiliz or to an Ethereum? I mean, the incentive structure and the way these tokens are designed certainly encourages that. It's just a matter of, whether or not it has staying power or not.
Well, I mean, and I think that speaks to low switching costs, right? Blur is a good example, right?
Mm-hmm.
Blur incentivized individuals, or those trading, buying and selling NFTs, to use the platform on the, on the premise of an airdrop, right? And there's, all you have to do is connect your wallet, and then you can use Blur. right? So, and there's no, there's no difference necessarily in volume or anything. If something's listed one place, it can be picked up anywhere else because it's all just
Mhm.
open source and an open architecture. Um, Whereas I think a lot of pre-blockchain methodologies are not open architecture, so it by definition creates potential moats or barriers to entry. Where here it's far more difficult.
Right.
Do you think? And I'm just thinking out loud here. Do you think that only increases as we become more and more of a multi-chain world?
Yeah, and I mean, I think it's a really interesting point that you're making because, I think if you ask most people about how easy it is to use blockchain, most people would say the UI and UX is not quite there yet. A lot of developers have prioritized functionality on the back end more so than usability on the front end. But at the
Hmm.
same time, what you're saying is the opposite of that, which is that it's actually really easy to switch and just to move to the next best thing when you hear about it, which is again not true in the pre-blockchain world. Right? Imagine how many if you have a bank account or a brokerage account and just the switching costs of going somewhere else, it's a pain, right? With all the paperwork and all the asset movements and the time it takes to wire money. And so, I mean, there's definitely something simplistic about, yeah, if you just hook up a wallet and are able to move from one to the other pretty seamlessly. It there is a simplicity to that, and I think to your point, when we head more towards a multi-chain world, which we already are, right? I mean, Ethereum again has 65 to 70% market share, but it's not like there is activity on Solana, right? There is activity on Binance Smart Chain. Even something um, uh, uh, like Kanto, which just kind of popped up overnight with the fair launch and a new blockchain. I mean, there was users immediately there. So you are going to have a multi-chain world, even if there's one or two that dominate it. Um, and I think if some of these bridges continue to get better and are more successful, then yeah, I mean you're always going to have low switching costs and a lot of movement. So I think that's why the onus is on these companies and projects to not only have that flash where you get these immediate users and this immediate growth because of the incentives, but how do you actually make it a long-lasting product? Right? How do you
Hmm.
create some of those? How do you create some stickiness, um, which gives customers as well as investors a reason to stick with you? And we haven't seen a lot of success there, right? I mean, I said like Binance, Uniswap, DYDX, Ethereum, and you could say Tether as well, right? In the stablecoin world, I mean, very few of the subsectors in digital assets have more than one or two major leaders, right? I mean, most of them are if not monopolistic, they're at least duopolies or there's not a lot where it's really spread out.
Well, there's probably two main drivers, right? One would be economic incentives, and I think like Uniswap is a good example. Blur is a good example of that, right? Given the fees that OpenSea charges, and you saw OpenSea just kind of cut fees, might have even waived temporarily just to compete with Blur a little bit more. And then the other probably is security, right? And I think that's a big focus, obviously, of Ethereum, and a big advantage that Ethereum would have over any kind of newer entrance into the layer one space. But is there anything else that you think is going to be increasingly important when we think about evaluating opportunities into the future to I
Yeah,
mean, obviously it's just create a good product that people want to use, but there's economic incentives and there's security.
yeah. I mean, a lot of it also comes down to just liquidity, right? Right. Again, right now it's largely infrastructure. Once we get beyond infrastructure and you start having hundreds and thousands of apps or a Starbucks to blockchain
Hmm.
initiative or Disney, I mean, it'll be different. But right now, while we're still in this infrastructure stage, liquidity is a big part of it. Most people, even the loudest people that you hear, are really either I'm all for centralization or I'm all for decentralization. The majority of people really don't care that much between decentralization and centralization. What they care about is this easy to use? Are my friends there if it's a social network? Is the liquidity there if it's a financial app? You think about even stock trading, right? I mean, there's hundreds of brokerages, but the reality is all of it flows through the NYSE and the Nasdaq, right? It's ultimately you still have sort of a duopoly where all of the liquidity providers show up, and then there's these offshoots from it. Um, and I think the same thing is, why is JP Morgan and Bank of America such vertically integrated businesses where you can do everything in one place, right? That one-stop shop is just easier for customers. Where you can get your mortgage, you can do your banking, you can have your credit card, you can have your brokerage account all in one place. So I think, ultimately that's kind of where you're headed toward, right? Either you're going to have one or two, apps and protocols that are just, it's the one-stop shop where I can do everything. And right now Ethereum is largely that, right? Especially with the L2s built on it. Or you're just going to continue, like you said, if any app can just immediately plug into your wallet and you can just go seamlessly, then you're going to be able to move around quite easily. So I think it just depends on where the users are, where the liquidity is. And ultimately those who capture that will create their own moat. And I think you're seeing that in the numbers. Again, there's no reason, there's plenty of competitors to Uniswap, but Uniswap has created a good, easy platform to use. It has lower fees and it's retained the market share, even though there's no incentives, there's no rewards. So that's just as good of an example as any, where there's always going to be competition there, and yet they've been able to maintain that market share.
Sure. Go back to one thing you said when you talked about people not caring about decentralization versus centralization, and I think people don't care about it until they have a reason to care about it, right? Because you can I don't know if you've ever sold something on eBay or something and they reverse a transaction because someone contests it, right? And that's something where you probably really wish it was decentralized.
Yeah.
And then there's probably other times where you might click on a bad link and you get hacked and there's nothing anyone can do to reverse an Ethereum transaction, right? So I think I think we'll probably, and this is maybe a good segue into the regulatory aspect of it, but we'll probably see an environment where there are centralized players and decentralized players because they serve very different purposes and they're very different value propositions, and there's reasons for both to exist and leverage the technology. And I don't know if that's something you necessarily agree with or see, but I think that's where we're going.
Yeah, I mean, to be fair, I didn't say people shouldn't care. I said for the most part, people don't care. I think
no, I know.
I think there are certainly reasons in some cases why centralized is better, right? Speed and the ability to unwind a transaction. I think there's a lot of cases where decentralized is better. With regard to censorship and even fairness amongst players. I think more people are starting to care, right? I think the events of last year certainly shook some people. What I'm mostly trying to get at though is I think most people want an easy experience, right? And when you get those easy experiences where they work and they're not egregious and from a cost standpoint, people will be sticky even if there are easy switches, right? And I think again that's why something like MetaMask, something like Uniswap, I think that's why they've been sticky, is they're just easy and they work with everything, right? So I think it's hard to achieve that, right? There's a reason we only come up with a handful of examples right now that have achieved that, but those handful of examples are what others who are building in the space are looking to achieve.
Yep. Yeah. No, I think that's right on. And yeah, it didn't mean, certainly wasn't implying that you were saying they shouldn't care, but no, I think that's a really fair point. So, let's delve into because there has been a fair amount of regulatory headlines this year, and as I think negative as the Twitterverse makes Gensler's actions out to be, and not to say that they aren't negative in spirit, it hasn't affected the market at all. And frankly, I don't really think it should. Kind of given where we are. But let's just break it down into a couple things. So we have the SEC proposed rule on custody, which frankly affects assets far beyond digital assets. We have the New York financial services on Paxos and the Wells notice. And personally, I think that's more of a commentary on Binance than it is Paxos or stablecoins or anything of that nature. And then we have, I guess, I'm curious to hear what your take on this is. But as I look at the overall environment for stablecoins, I think from a regulatory perspective, it was always viewed as more low hanging fruit to be able to create some sort of legislation or regulatory framework around stablecoins, though it certainly seems that that has been um, pushed to the back burner a little bit in favor of a view by many members of Congress to do something more comprehensive. But I guess we'll see over the next few weeks where that all shakes out. But I think the view of stablecoins, as a security, potentially how they're viewed, how they're custodied, how they're regulated, on ramps, off ramps, things of that nature, is something that probably isn't dead, even though it hasn't been talked a lot about. So of those three things, I guess what catches your eye the most?
Yeah, I mean, generally when there's new information, I always try to process it both from a top-down standpoint and then a bottoms-up, right? So top-down, intuitively, does it make sense to have a more oversight of this industry and to have better disclosures and better risk factors? Of course, right? I mean, I think that makes all the sense in the world, right? There's no reason why somebody should be able to sign up for BlockFi in 4 seconds and transfer their money there thinking it's a bank and not understand that they're basically operating hedge fund strategies and moving your assets around. Then if they go bankrupt, you become an unsecured creditor. I mean, that's obvious, right? And you could say the same thing about, FTX or, USDC or, anything, right? I mean, that you should have better disclosures, better transparency before you are putting your money somewhere. Now, you could argue the ways that we go about it with, 65 pages of legalese and fine print doesn't exactly solve that. But the idea of if you're about to put your money somewhere, you should understand what those risks are, intuitively makes sense. And then if you go bottoms up, though, and look at the individual actions, again, you could say that, okay, well, let's go back to top down, right? We know long term, if we have a better regulatory structure, both in the US and abroad, that is a long-term positive, right? It's going to bring more people into the pool. It's going to make people safer. It's going to make adoption grow. So long-term, that's good. I think the reason people mostly thought short-term this would be negative is they thought it would really crush the players in this industry. And what we're seeing so far is it's not really true, right? It's not broad sweeping. It's been very targeted. So for instance, when Kraken was targeted and had to shut down their liquid staking program, the assumption was that, okay, that's it. If you're a liquid staker, you're in trouble. And the reality is it wasn't. It was very Kraken specific. It was, you are offering a fixed yield to people who stake through your program, but you're not explicitly saying exactly how the staking rewards are flowing through to the users. Therefore, this is an unregistered security offering, and you, Kraken specifically, must shut this down. It wasn't really an attack on staking. It had nothing to do with staking at all, really. It had to do with the way that staking mechanism was being passed through to users of Kraken's platform. And now you can say the same thing about the, what happened with BUSD and the Wells notice between Binance and Paxos. I haven't seen the Wells notice, so I don't know exactly what was in there. But again, this seems
you're not going to see it. No,
yeah,
they're not disclosed.
Exactly right. But this is, this appears to be not necessarily just anti-stablecoin. This appears to be anti the way this stablecoin specifically was issued and disclosed in terms of, it was, I believe it was the NYDFS approved it on Ethereum, but not on Binance Smart Chain. And they basically have a wrapped version of it. And that itself wasn't necessarily a kosher way to offer this product. So again, immediately the knee-jerk reaction was, that's it. They're going to label every stablecoin as a security, and stablecoins are in trouble. And the reality is, okay, maybe it's just the way that one was packaged. So, from a micro level, again, if you believe in the growth of blockchain and you believe that long-term regulation is good, it doesn't really preclude you from still investing in the areas of growth, like layer 1 protocols and layer 2s built on it, like some of the DeFi apps, like some of the Web3 apps. And you're seeing those rotations, right? I mean, immediately on the BUSD news, for example, you saw a lot of the curve pools starting to get imbalanced because people were selling, BUSD is not part of curve, but USDC, right? Anything that was in the throes of potentially government regulators was being sold. And ironically, Tether was the one that was being bought, right? The price of Tether immediately spiked above $1. And you're seeing it in AUM rotations, right? The AUM of BUSD is going down, and the AUM of USDC was going down as the AUM of Tether was going higher. Similarly, on the Kraken news, you didn't really see ETH sell off or other proof of stake protocols selling off. In fact, you just saw the other liquid staking providers, things like Lido and Rocket Pool and Frax really take off, because essentially what you're doing is you're taking one of the larger players out of the market. Kraken was 7% of liquid staking. I think Coinbase is another 11%. You assume that business will just flow elsewhere. So you're seeing rational responses to some of these individual action items. Sorry, go ahead.
No, so a couple of things. So one, I mean, from a USDC standpoint, I mean, I don't. You maybe had I looked at it a week or so ago, but I don't really think you saw much of a dip in USDC outstanding. I know you did with BUSD.
You did initially, right? Because initially
okay.
The initial reaction was that they're coming after Paxos, they're coming after Circle and Coinbase as well. Now, that hasn't happened, and there's not necessarily a reason to believe it. But that was the initial.
I don't think it will. Yeah.
Yeah. That was the initial kind of knee-jerk response. But the point is that again, we've just seen this over and over again, right? When a couple of years ago, when China banned Bitcoin mining, what did you see? Everyone's like, oh, well, that's it for the that Bitcoin mining industry is in trouble. Well, actually, no, it just moved to Texas and to other areas, and hash rate didn't change at all, right?
Still in trouble.
Yeah, I mean, BitMEX used to be 40% of the Bitcoin derivatives market, and when they were probed by the DOJ, BitMEX went from 40% down to 4%. But that wasn't the end of derivatives. Derivatives just went to Binance and FTX and to DYDX, et cetera. I mean, you just see this over and over again when there's a hiccup at a specific entity. Again, if you've been in any economics course, they'll tell you when there's perfect substitutes, it doesn't have an impact on price because the business just moves elsewhere. And I think that's why you're seeing no reaction at all to prices right now, is that these are individual attacks on companies that are providing services, not on the services themselves.
Not on the services themselves, exactly, and not necessarily on all companies, right? I mean, you mentioned Coinbase, and I don't know if this was intentional or not. Maybe I'm missing something, but kind of lumped them in with Kraken. I mean, I look at, Coinbase has a ETH2, right, a derivative product, but from a staking standpoint, it's very different than what Kraken or BlockFi offered, because it's a direct pass through from the protocol, right? A variable rate. There's nothing promissory about it. If you stop getting yield for whatever reason on ETH2, you stop getting yield on the staking. All they're doing is offering retail ETH holders the opportunity to pool their ETH together, essentially, in order to have staking rewards, because I think you need, I don't remember, 20, 10, some amount of ETH to be able to stake it and proof of stake and earn that yield. And if you have, a half an ETH or 1 ETH, now you can stake with Coinbase, but it's not the same as saying, custody your assets here and we'll pay you a 7% yield, right? That's and I don't know if you've seen different or heard different, but I have not, from a regulatory standpoint, heard Coinbase's staking product mentioned at all in that light, nor USDC in the kind of Paxos BUSD light.
Yeah, the only thing we saw was that executives at Coinbase came out and directly refuted that this was going to have any effect on Coinbase itself. So yeah, that's it. So I think that led to people thinking that maybe they were next, but I think it was more of a proactive move by Coinbase executive. Either way, regardless, though, I think the point is that we've yet to see anything that suggests that there's any broad sweeping part of the digital asset industry that is being shut down, so much as it is certain players in the market are being asked to pay fines or change. So if that's the case and that continues, again, I don't see any real reason why this would flow through to the prices of many of the assets that are not being touched.
Look, and there's a lot of talk about Gensler, right? And and I think you wrote about this as well, but I don't think he's wrong in spirit on a lot of this stuff. Like from a custodial standpoint, for one, right? Like the assets should be, should be held separately from firm assets, right? They shouldn't be commingled,
Right.
with side hedge funds or prop trading assets. They should be in a qualified custodial arrangement of some sort so that client assets are protected. Now, if that's impossible or exceedingly difficult, because of a cascade of other outcomes or market dynamics, then so be it. It needs to get resolved in some capacity,
Yeah.
which is why you have comment periods and implementation periods and so on. And I also don't think he's wrong. Maybe the approach was wrong, or some of the things were less. Some of the ways in which it's delivered is disingenuous. But yeah, you probably shouldn't be, as a centralized entity, catering to retail or getting them to put all their funds in under some promissory unsustainable yield that's not directly tied to the inputs, right? It's just the firms are not built the same way as a bank or another kind of regulated financial institution. So I don't think
Yeah.
any of that is wrong.
Yeah, I agree. I think like, from a just from an intuitive standpoint, most of it makes sense. I think it's the custody rule, which we haven't gotten into yet, where I think where you start to lose that, right? I think the most of the things we've heard out of regulators, not just the SEC, but regulators in general, at a high level, at least makes sense. Now, whether or not they're implementable is another story, but at least from a high level, they make sense. I think the custody rule one is a little bit different, right? Which is effectively, saying that, that the new rule for custody of client assets is essentially that you have to hold everything at a qualified custodian. And this one is a little harder because this, again, as you said, this is not just affecting digital assets, right? I mean, this is going to be all registered investment advisors are going to have to follow this with all assets. And, you start to question, well, what does that mean if you own taxi medallions or art or real estate, which obviously also can't be held at a qualified custodian? But even from a digital asset specific standpoint, I think the hardest part about this is that blockchain, by definition, relies on real-time settlement, right? The whole point of peer-to-peer trading and blockchain rails is that you can instantaneously send and receive assets. So as a result, if you have any interest at all in blockchain finance and the ability to trade and move assets, you really only have three choices, right? One is you hold your tokens where you trade them, which is effectively an exchange, not a qualified custodian. You use self-custody and interact with DeFi, right? Something like a MetaMask wallet and use a Uniswap or something like that, also not a qualified custodian. Or you hold all your assets at a qualified custodian, and then you settle the transactions later using an OTC provider. Essentially, you can't really do anything other than those three options if this proposed rule were to go through. And essentially what you're basically saying is that the regulators are telling you, we like the way the traditional bond and equity markets work, where it's T+1 or T+3 settle. We like the fact that everything is slow moving and there's 100 middlemen. By definition, they're basically saying we don't like blockchain, which I don't think is the stance, but that's sort of the accidental, I guess that's sort of the accidental interpretation of what they're saying. And I just don't know how that's going to play out. I mean, obviously, again, this is just a proposal that's going to go through a bunch of comment periods. It's going to take, years for this to ultimately come to light. But it's certainly a little troubling, right? Because I think most of us in this space recognize that, hey, instantaneous settlement and, T+0 and the ability to move assets freely and cheaply and instantaneously is kind of an advantage of blockchain. And holding this at a qualified custodian and having to wait 2 days to get your assets, we're kind of back to what, the pre-blockchain era.
Yeah, I mean, look, I think there's a couple of new moving parts, right, and nuance. There's one, holding assets at a third party qualified custodian, as opposed to the, any asset that the RIA either has control of on behalf of the client, where they are basically the only point of failure, right? Or that they can reasonably get control of. And that intuitively, I think, makes sense, right? Now, they also say that, if there is no available, unless there is no available qualified custodian. And now that becomes, there's a lot of nuance there, right? Because, okay, take art, for example. I think, one could argue that, they wrote this in to alleviate, certain assets that have been around for a long time, like art or, rare whiskey, or you name the asset, right? That's not going to have a qualified custodian. And then the other way of looking at it is like, well, what do they mean by qualified custodian? Like, what are they really getting at? And I think what they're getting at, if you look at like the commentary a lot, is, separation of assets, right? Not a commingling of assets, right? So a custodian that can say, even if, the IRA goes under or we go under, right? Like, your assets as the end client are not commingled with other assets. They're separate. They can easily be, returned to you. Like, just because something happens to one entity doesn't mean that, every underlying investor of some advisor is screwed because of that.
Right.
So are there ways of, resolving that in a blockchain environment? Yeah, of course, but it needs to be defined, and there need to be players that are, like, all right, take Fidelity Digital Assets, and I actually don't know the answer to this, but like, are they a qualified custodian? Now, they only custody Bitcoin and ETH, but would they be considered a qualified custodian? I mean, they have separation of assets, right? Like, they're non-commingled. I honestly don't know. Are they a qualified custodian?
Yeah, I don't think, no, I don't think they are. I don't even think Coinbase is. I think under the current rule, I think Anchorage is.
Yeah.
And I think that might actually be it in terms of actually qualifying right now. I think BNY is as well, and I think they're just sort of getting started. But it's not a long list that are designated, at least legally, as a qualified custodian.
Yeah, I'm probably barking up the wrong tree. I'd be interested to say, like, what makes one. It's just a license, the way they're regulated to make one a qualified custodian.
Yeah, I'm not 100% sure. I know there was several companies that were trying to get licensed and were being held up for whatever reason. I don't know exactly what it takes to be deemed a qualified custodian, but again, what exists today is not a very long list.
Right. Yeah. No, and I know Anchorage. I think you got right about Anchorage. That said, yeah, it's surprising, when you look at, and like Fidelity, and let's go to the rulemaking. So, like, okay, great. So, could be draconian, but what does a rulemaking actually entail? Kind of a regular way rulemaking like this. They put out a proposal, right, which they've now done. Once that proposal is put out, it opens up a 60-day public comment period, which we're in right now. So, as you could imagine, there's going to be a lot of comments, right? Big formal ones from Coinbase and Fidelity and all these funds and all these large players, to anybody who wants to provide a public comment. After that 60-day comment period is complete, the SEC reviews the comments, right? And that takes however long that takes. And after the review, they can adjust the proposal, they can rescind the proposal, they can decide to move forward as is. There's a lot of things that they can do. And from that, there could be action, but there's always an implementation period, right? And even if you look at the comments of the Fed governors who voted in favor of this rule, they were aiming for a 12 to 18 month implementation period post the final rulemaking. So we have the proposal, we have the comment period, we have the final rulemaking. And that's probably aggressive. So even to say it's gotten towards the 18-month window on that, you're looking at 18 to 24 months, probably on the earliest, that something would be implemented that we don't know what it's going to look like from a final standpoint. So in that 18 to 24 months, you could have changes in definition of what a custodian is. You could have new applications approved. You could have a totally different infrastructure. You could have, and most likely, you could have a new administration. And you could have Gensler, who has a lot of political aspirations, doing something totally different. And, we're still waiting on implementations from Dodd-Frank that were passed into law that still haven't been enacted yet. So,
Right.
I think there's a lot in the digital assets world where they're getting used to regulation and what it entails. But just because a proposal comes out there doesn't mean it's going to happen, and it's certainly not going to happen anytime soon.
Yep, exactly. And I think, look, as you mentioned, the biggest thing is that we saw already, I think like a year and a half ago, I forget which, you know this better than I do, but there was some proposal that Washington was very surprised, I think, at how much bipartisan pushback there was and how many people care about crypto and blockchain.
Mm-hmm.
I know you probably remember which one it was, but it was basically it was just attached to a bill, right? There was some,
Yeah,
I think,
I remember exactly. Yeah, and it ended up passing too.
yeah,
But it brought up this would have been last spring, not
no,
yeah last spring or 2 springs ago,
yeah, I think it
2021
was two
spring.
springs ago. I think it was middle of 2021.
Yeah,
But again, I think, there was a lot of companies and funds and individuals who really cared, and I think that surprised people. And I think this is the same thing here, as you
yeah,
mentioned. This is not just a digital asset proposal. This is going to affect RIAs across, many different sectors and investment mandates. And I think
yeah.
once
Real
again they'll be
estate, anything.
surprised. Yeah, they will be surprised by how many companies and lobbyists and individuals care and provide comments on this. So I think people always ask me like, what am I doing as an investor in lieu of some of these things coming out of regulators, and the answer is not a lot, right? I mean, I often say like I don't just carry an umbrella with me every single minute of every day. If it actually rains, I take an umbrella out and I will adjust to the fact that it's raining. And I think the same thing is true here, which is that as a company, we're certainly reading all of these proposals. We're trying to do things that we think will be long lasting. But as an investor, I'm investing in what is investable today that has the growth prospects. I'm not, trying to think 3 to 5 years ahead of which rules may or may not get passed in which fashion. So again, just another reason why I think very, very long term, probably a good thing. Medium term, uncertain, but short term, really no effect, right? And I think that's another
Sure.
reason why a lot of what we're seeing right now is just being glossed over by the market. It just doesn't actually have a near term effect on. And you think about how fast this industry grows and sometimes collapses. You're going to have so much growth and or failure between now and when some of these rules get enacted that it's just not really relevant from the investment standpoint today. So it's not that we're not aware of it. It's not that we don't care. It's just that it's just not super relevant to what we're investing in. And again, I'll just kind of go full circle to what we talked about at the very start of this, which is there is just a resilience of digital assets that I think people are really starting to recognize. The joke always 2, 3, even 5 years ago when we started Arca, the joke was always like, I'm not going to invest in tokens. They have no downside support. I need equities where you have some support. And, you look at what happened in the second half of last year, and it was the equity investors of companies that got hurt and are going to end up in, last in line in the waterfall of these bankruptcy procedures at Celsius and Voyager and FTX and BlockFi and Genesis and you name it. But those who actually own tokens of similar businesses, right? I mean, all these companies I just mentioned who are now in a bankruptcy process all have a substitute or a competitor that's a different business that has a token. The tokens themselves are still going concerns. There's no bankruptcy process. They're not being primed by new debt. You could make an argument that tokens have both more upside and potentially less downside just because of the optionality of what has been created. So, I think, again, from an investing standpoint, we've learned a lot over the last year, and it wasn't just how negative all the headlines were. We learned a lot about there's actually something to be said about a blockchain that can't go bankrupt, that still fires, that still produces blocks. There's something great about a DeFi product that, can't get primed in a bankruptcy and can't, overextend leverage because it doesn't fit because some individual decision maker decided to do something. So there is sort of a new appreciation right now of what these tokens are, what they represent, what these protocols are, what these decentralized apps are. And it's giving myself and other investors some confidence that this is a real asset class that's worthy of investing. There's real fundamentals and there's real growth potential, independent of the headlines and news that we're hearing around us.
Yeah, no, I think that's well said. I think that's well said. So yeah, let's leave it at that. And as always, great Great conversation. A good start to the year, of course. And yeah, we'll see how it goes and talk again soon, Jeff.
Absolutely. Thanks, Peter.
Thank you.